Valens Research, Uniform Financial Analytics.
Sinclair Broadcasting is literally, it's a broadcasting business, right? For lack of a better word. You've probably heard about the company in the news because it's, somewhat divisive, et cetera. But basically what they do is they own broadcasting businesses. They own channels across the United States for Fox, for NBC, for ABC, et cetera. And what they've done is they've really been one of the big consolidators of the industry. They've bought up parts of the industry and then they improve the efficiency of those businesses. What they do is they combine different stations in a single network so that they can cut overhead costs. They also have more of the data and news actually produced in a centralized location as opposed to at individual news stations, so they can save costs nationally, et cetera. And because of that, what we can see is real uniform accounting return on assets for this business has been a lot higher than as reported metrics reflect. And also for this year, because of what they did in terms of some operational things that they did, returns were a lot stronger, and including what they did basically in terms of acquiring the parts of the regional sports broadcasting networks from Fox, part of the Disney acquisition. But what's really interesting about this company is, right, if you look at it on an as reported basis, you would think that it's a low return business trading at a cheap valuation. But on a uniform accounting basis, what we can see is return on assets are actually a lot stronger, right? They've basically been over 25% a year, every single year for the last 12 years. And this company isn't trading at a 5 times multiple, which would say the market is pricing this company to basically collapse tomorrow. The company is actually trading at a 15 times multiple, which is a little bit below market valuations. But for a business, right, and broadcast media is a declining business, trading at a 15 times multiple is not unreasonable. All of a sudden, we understand it is a better business than we think, but it's also not trading nearly as cheap as we would think. If you were to screen on this company using as reported metrics, you'd be like, wow, a 5 times PE, incredibly cheap. No matter how bad a business is, you should buy a 5 times PE business. Well, the issue is this isn't a 5 times PE business. This is a 15 times PE business, and there are plenty of declining businesses that trade at 15 times. Again, the uniform accounting metrics change our conversation about not just how profitable this business is and whether or not it's relevant from that perspective. It also changes the context for us about whether valuations are interesting for the business or not. Because if we understand that it might decline over time, well, trading at a 15 times multiple is not unreasonable at all. And right, if I were to say that organically, right, because a lot of this growth has been acquisitive for Sinclair, if I were to say organically, Sinclair really is not going to grow at all going forward, and I put in a 0% asset growth here, at a 15 times multiple, the market is pricing return on assets going forward to probably be around 22 to 25%. Yeah, 23%. Well, that is low relative to history. It's not that low. And for a declining business, that actually looks pretty reasonable. In fact, for this year, it's only forecast to be 29%. All of a sudden, because I realized that PEs aren't as cheap as I thought, I can realize this company isn't as cheap as I thought, and maybe one to stay away from as opposed to one to pound the table on.
Valens Research, the world's leading source for uniform financial analytics.